Hey there, everyone. Happy Friday, February 6th. Welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from a frigid, cold Boston, Massachusetts. Did a tour of Boston University today. That was awesome. It's cold here. So the Seattle residents are struggling a bit with the severe winter conditions. However, still smiling and happy to be joining you here on the show. Today, I tell you what, today was either the mother of all dead cat bounces or the beginning of a broad recovery. And here's what I mean, right? When you have a market that has been selling off, then you have a big sudden upside reversal with a ton of positive breadth, ton of positive momentum. That is often called a dead cat bounce, which is creates a horrible visual to represent a common phenomena, which is in a bear market phase. Some of the biggest up days you're ever going to experience are in bear markets, and they're on days when an initial rally gets people all excited, drawn in, significant upswing. We've seen with technology today up 4+%. So what happens on a dead cat bounce day? The real question is not whether those days are going to happen. They do. The question is what happens tomorrow. So in this case, we've got to wait for Monday and Tuesday's session of next week to see if there's a return to the bearish trend that led into Friday's severe rally, or if this is the beginning of a big recovery. In either case, it looks very, very, very similar on the day of that big upswing, and it draws a lot of people in. We've seen that with the S&P and the NASDAQ obviously pushing higher. We see that with cryptocurrencies having remarkable up days after being down double digits days this week, up double digits today. So the reality is those things are still down for the week. However, Friday was a significant upswing. The S&P not quite getting to that 7,000 level again. I feel like the market gods heard when I said I did not bring my trumpet to Boston, so you can't go above 7,000 until Monday. Maybe that actually played out. All right, here's what we're going to do today. We're going to do a very brief market recap just to talk about the severe up days. Some days on Fridays it's kind of quiet. This was not one of those days, so I just have a couple things I want to highlight for all of you in terms of how conditions changed today. Then we're going to get into some of the questions that we received from you guys over the last week. And thanks again, all of you, for adding questions on our YouTube channel. Very much appreciated. Great to hear what you guys are struggling with, what you need more information on. And I've hand-selected some great questions to feature with you. It's never too late. If any questions come up during the show, as always, use the comment section on our YouTube channel. We would love to hear from you. All right, quick market recap. And by the way, market misbehavior premium members, just hold tight because our weekly flight plan will be dealing a lot with some of the conditions that we evolved on Friday, whether we feel this is more of a dead cat bounce or the beginning of a broad recovery. I'll save those that speculation and additional insights for our premium members. Never too late to become a premium member, by the way. You can get more information at marketmisbehavior.com/premium. You get virtual courses. You get a member community where you can ask questions at any point, and also some really good members-only reports like our weekly flight plan. So here's what happened today. The S&P grinding higher open, stronger through the course of the day. No real pullbacks to speak of, and that puts the S&P to close just above 69.32, and that's up about 2% from Thursday's close. The Dow even better. Even though technology was the top sector, the Dow actually outperformed the S&P and the NASDAQ. The Dow was up 2.5%. Mid caps, however, the best of all, up over 3% today. That's one of the biggest up days certainly we've seen in quite some time. The VIX, with all this optimism and all this risk-on sort of movement after Wednesday and Thursday, showing quite a bit of vulnerability. The VIX moving back below our red flag level of 20. So going into the weekend, certainly a different vibe than what we had through Thursday's close, where the market looked incredibly vulnerable. Certainly looked like this could be, one of the worst weeks in quite some time. But the VIX dropping 4 points, going down just below 18. We're in a 17 handle for the VIX. So back to a low volatility, not much to be worried about type of level. With all of that movement in equities, honestly, the bond markets were relatively quiet when you look at the directional move through the course of the day. Now, the TLT, which is a bond ETF that we track, sold off in the first hour of trading, but the whole rest of the day started to recover. And by the close, it actually spiked to be net positive. So bonds basically flat for the day. And the yield curve, not much of a change from what we saw yesterday. The dollar weaker, but not too big of a drop. Even though equities and cryptocurrencies, you'll see in a minute, were up. Gold and silver up as well. The GLD up 3%. Silver pushing above $70 a share. That's on the SLV, so that's up over 5%. Copper prices higher. Crude oil prices slightly higher. Energy stocks had a pretty decent day as well. Biggest reversal, though, Thursday, we had an acceleration lower. When we were doing this show yesterday, we're talking about Bitcoin in the mid 60,000s and what downside objectives might make sense. We actually hit almost exactly to the penny at $60,000 per Bitcoin before rallying. We're currently trading just below 70,000. So that's up 11% from yesterday. Big 2-day reversal, right? With a big down day yesterday, a big up day today. That is a pretty bullish candle pattern, as you'll, I actually don't have the chart, so I'll go there real quick. Pretty bullish candle pattern, right? If you look at the daily view, and let's look at a candle chart. Now, candle charts on Bitcoin are a little weird because you have to wait for the 24-hour close, but it's basically it's called a bullish piercing line. When you have 2 days, one big down day, this is almost an exact open. And the reason is because there's no real change on Bitcoin. There's no real gap from one day's trading to the next. So candle patterns are not exactly easy because you will never have a big change from one day's close to the next day's open. But the fact that we've had this 2-day reversal with a big upswing, I'd call that a bullish piercing line, which is basically a bullish reversal candle. In terms of sectors, as I mentioned, technology, the big winner today. You're seeing a big countertrend rebound in technology stocks, up 4%. MEI stocks, which are materials, energy, and industrials, all doing well also. And that's number 2, 3, 4. The industrial sector up 2.8%. Materials and energy both up about 2% for the day. Communication services, the only S&P sector in the red, down about 1/3%. Consumer discretionary, 1/3% higher, followed by utilities, up just below 1%. We'll have to update our market trend model after the close and see what happened. This might actually bring the short-term model back bullish. Keep a note that the breadth was really strong with a 4-to-1 ratio of advancers over decliners on most of the major indexes. Biggest bounces here in the technology components within the Magnificent Seven. NVIDIA and Broadcom both up 7%. Now, granted, these are still not great charts, I would argue. These are still struggling to recover, but a nice rebound after a whole week of down closes and ugly action. NVIDIA having an incredibly strong recovery back to the upside. Amazon, however, gapping lower, finishing down about 5.5%. Alphabet, after this week's earnings and yesterday's lower open and move higher into the close today, what's called a bearish Harami pattern, which is a bearish inside day, down another 2.5% off of yesterday's close. Again, we'll dig into more of those themes over the weekend with our market misbehavior premium members. So those of you that are as such, keep your eye peeled for that. As a quick reminder, tomorrow morning, 10 a.m. Eastern, 7 a.m. Pacific, I will be participating in a fantastically fun event called the Super Bowly. Tom Bowley of Earnings Beats invited me and Grayson Rose and Julius DeKempener, both from Stock Charts, to participate in a fantasy stock draft. We'll be each picking a team of 10 stocks. We'll be talking about what's motivating those picks. Should be an interesting discussion. Also, I've told the Stock Charts scooter rankings will be an AI, basically a simple AI version. It's going to pick the strongest scooter ranking names. That's using Stock Charts' proprietary quant model. And then we'll measure those picks over the next couple months and track their performance over time. Should be a lot of fun. You can sign up for that event at marketmisbehavior.com/Super Bowl, or just scan the QR code that you see on your screen. Hope you can join me there. It should be fun. All right, let's get to some questions. And again, these questions all came from viewers like you over the last week or so. And let's get to question number 1. Dave, do you use AI in any capacity within the world of Dave and trading/investing? I actually have used AI outside of investing, probably more than I have inside of investing. And I will tell you, I found it to be incredibly valuable for things like booking travel. Our trip to Ireland with my family last summer, we basically created the itinerary largely through ChatGPT and just asking questions about cool things off the beaten path. We found some fantastic music related things, historical sites that we would have may have found otherwise, but just did a really good job of helping us figure out how to navigate a country like that. So for travel, fantastic, and I've used that a bunch of times since because it's been a really valuable. I'm in a new city for a day or two and want to explore a little bit. It's always great at identifying some things. But specifically within trading investing, I mean, to be honest with you, the main way that I've used it, which I would encourage you to use as well, is thinking of AI as basically a junior analyst, right? When you're at a firm like Fidelity, which I was for about 9 years, you have junior analysts or junior associates. These are, some, interns are people that would work with your team, but junior analysts are basically people just getting started. Probably have a fantastic career ahead of them. They're really smart, and they want to learn from people that are more senior. And so you basically had endless supplies of their time and resources to dig into questions. So I remember asking one of my, research associates at one point, "Hey, I want you to read these couple books because I know they talk all about market tops. I want you to tell me, just can you synthesize what you read there and share with us some best practices of how these different practitioners have tried to document major market tops, right? What motivates that? How would you compare and contrast them?" Great project, and it basically gets them to read books you wouldn't have time to read and to summarize them in into key things. ChatGPT is awesome for stuff like that. And so I've asked it to look into different people and their opinion because it can dig into their research reports. I've had it break down earnings calls and a lot of platforms like Koifin that I use, EPS Momentum, which is another platform I just started to use, pretty new. And they have AI built into it, so it can summarize earnings calls and summarize a company's business model, and those I think are very helpful. The challenge is AI, at least at this point, tends to hallucinate sometimes, right? It'll make stuff up because it's so, the way I would think of it, it's so desperate to please you with its answer. It's not guaranteed. Now, the problem is that happens with research assistants too. They sometimes aren't right. And so you have to correct them and say, hold on, where'd you get that from? That doesn't sound right. So I don't think you can blindly use AI. AI is not perfect. And just because AI says something doesn't mean it's necessarily accurate or true. And that's something where I think people are getting a little ahead of themselves with trusting what it says. But that's how I think of it, right? Asking it questions to help you better understand a sector. I remember asking, so I was trying to think of how to break it down. Tell me about the different components in the S&P 500 energy sector, and how would you describe their businesses, and how are they different? How are they similar? And it was really helpful, right? That sort of led me down a discovery process, helped me think of other things to dig into. Other things I would say, charting platforms like Optima come to mind. They're doing a really good job of including some AI tools because every charting platform is a little different. Sometimes it's hard to remember on this particular platform, how do I create an indicator and color code it by a certain thing? Like when you're trying to do some crazy stuff, they're developing tools where you can say, I want a line that shows me the MACD and color code it green if it's up or red if it's down or something like that. And it'll just do it. So I think that will probably make the idea of building charts and experimenting with different visualizations a lot better. One thing I found it's not as helpful with that I wish it was. And if someone wants to build this AI kind of capability, let me know because I'd love to use it. This sort of history lesson, right? So tell me every time the S&P closes up 2% on X volume, and add some criteria, and then have it run a back test of what happens in the next 30 days or something like that. It'd be really cool. That it has to have access to really good data, and that's where I think it's only as good as the data that it's able to synthesize. But that would be an AI function that I think would be incredibly valuable just to understand cycles and understand market trends. But as a junior analyst, I use it all the time. I found it crazy helpful. Again, my disclaimer is do not believe everything the AI says because I often find incorrect answers and I say, wait, what do you mean by that? And it goes, oh yeah, nice catch. That's not right or something. And I'm like, cool, that's great. All right, next question. Do you factor in after hours or pre-market action in your analysis? So the answer is on a limited basis, and the most important answer is when I think it's going to be helpful, and I'll tell you why. Right. So when you're looking at a company and you're doing, let's see, here's an intraday chart of Microsoft. I'm thinking of something that's Let's do like an earnings name this week, right? So here's Alphabet. They reported earnings this week, and we can see the gappy nature to what happened on Thursday, and then into Friday. Now this is just looking at 5 days, but just using the sort of pit session, right, from 9:30 a.m. to 4 p.m. Eastern. But on stock charts, and most platforms have the ability to look at extended hours. So here I'm adding the pre-market, which is shaded green on stock charts, and the post-market or the after-hours session, which is color-coded in purple. Then I can see the immediate reaction after earnings. They reported earnings Wednesday after the close. So now I can see the sudden reactions as the numbers came out, the additional reaction as the earnings call is happening, and you can really gauge the instant reaction to what you're hearing. So the answer is, I use it for that. I use after hours trading and pre-market trading when a company is reporting earnings and the markets are closed. It's outside of normal market hours, and I just want to see what's going on. With a big economic release before the open, right? Jobs numbers or something. So a lot of them will come out before the open, like at 8:30 Eastern. A lot of economic data. So bringing up the S&P pre-market or futures or things like that, just to get a read on how are investors reacting to something that just occurred. I think it's very helpful for that. Would I base any major positioning changes based on after hours data? Absolutely not. And here's the reason, right? After hours data tends to be a lot less volume, a lot less liquid, meaning there's a lot, tend to be a lot more gaps because there's just a lot less participants. Most institutional investors would never touch the, pre or post market sessions. So it's just, the big players that are moving volume really aren't active there. So it's a very retail driven, trading session with just a lot less volume. So it's, you can't always trust what you see in the after hours as being a great sign of what's to come. An example is like, here, right? Thursday on Alphabet, it traded down in the pre-market session, but the moment the regular session opened, stock traded higher, and then in the post aftermarket session, it traded lower. The next day, pre-market, we opened up. So it's like it's not really connected to the market session as much as you want, right? The fact that it's down so much in the before the open really meant nothing to what happened on Thursday, which ended up being a pretty nice recovery day off of those lows. So because of that, lower volume, lower liquidity, less participants, and no institutional action or very, very little, I found it's not particularly helpful. And this is on an intraday chart. On a daily chart, there are some platforms I've seen, charting platforms that allow you to chart candles and bars that include the after hour session. I would strongly encourage you to never do that because I think it's important to think about the daily open and close as the pit open and close until we move to like 24-hour trading on stocks, which is going to happen at some point, just hasn't happened yet. Then we can change your mind about that. But for now, that's how I would think about it. All right, next question. Dave, do you use any ETF ratios that show when various foreign markets outperform various US markets, including segmentation by different market caps? On your last part there, no, I really don't look at like outside the U.S. I don't look at like European small caps or Asian mid caps or some sort of regional cap tier. If I was more of a global analyst, I probably would. And I know analysts based in Dubai or in India or in Hong Kong that are really focused on non-U.S. markets, and then they're really trying to get as much deep coverage of those stock markets as possible. And if so, then I would probably bring in as much different data to understand that. For me, though, my analysis of non-US markets is often more at a high level because the investors and clients that I work with don't tend to make a lot of individual stock bets outside of the US. And it's not just not an area I focus on as much. So it's more looking at the country level, at the regional level. And then it's a major name, right? So like, Chinese internet names are something that are pretty widely used, and a lot of those trade in the US as well. Other than that, it's really more randomly when I get asked to do a presentation and look deeply at India or, a particular Italy or Spain or something like that. And I'll do so. And that's one of the great things about the technical analysis toolkit is it really is ticker agnostic, right? It doesn't really matter according to the principles of technical analysis what the chart represents, right? It's more about the looking at the patterns that represent investor behavior, and so I think that's good. So to answer your question directly, what do I look at? So I have a couple things that I look at pretty often. Trying to show you, I'm trying to think of where all of these might be, right? So I mean, it starts for me at a high level looking at US versus non-US. And this ratio here is the SPY versus ACWI, All Country World Index. ACWI is a global index, so it's about 50% US, 50% non-US, or something about that. So it's a mix of US and world, like kind of the entire global equity market. That's the denominator. The numerator is the S&P 500. So this is the US versus the total world index. So if the line is going up, then the US is outperforming the global equity markets. If the line is going down, it's underperforming global stocks. And as you can see from Thanksgiving last November, all through December, January, now into February, the US has been dramatically underperforming non-US. And that, in a lot of ways is going to be based on the shape of the dollar. The fact that the dollar's been generally trending lower during that period is certainly a tailwind to that particular trend. And that's why I have the two of these together. You can see generally the shape of this relative performance is matching the shape of the dollar, right? Because a stronger dollar usually means U.S. equities are in a better position. Weaker dollar means non-U.S. markets are probably going to be in a better position. It doesn't always happen. You can see like last spring, summer, it diverged a bit, but generally that's the pattern that I've seen. So it starts at a high level like that. The other thing, and this is a chart that I show to my premium members when we do our monthly chart review, which we actually just did earlier this week. And the charts are not updated because I update them before we do our exercise, but this is like a year-to-date performance of the S&P 500 versus EFO, which is global developed markets, and EM, which is global emerging markets. And just looking at performance chart, which is what I would call this, looking at performance from a certain period of time forward is really helpful for just understanding leadership themes, in this case, year to date, demonstrating that non-US markets have generally outperformed the US quite well. The other thing that I will do is use relative performance, right? So chart non-US markets versus the S&P, and that's using classic relative strength. And I do that quite often when we're thinking about India or China. For my clients, which are mostly based in the US and Canada, buying something like India, it's not just making a direct bet on the Indian markets. You're probably taking assets that would most likely be tracking the US, and you have to justify, investing them in India, which means on a relative basis in US dollar terms, India has to be a better place to be. Otherwise, it's not a great bet. So looking at relative performance in US dollar terms, so that's doing the ratio versus the S&P, something I do all the time. Those are some of the ways that I think about non-US markets at a high level. And then when I see something that's interesting, like EM looking really good, dig into those country indexes a little better and see where in EM, because that's actually a pretty diverse area of the markets as well. All right, we're going to continue on here very, very shortly. I do want to thank my friends at Seeking Alpha for being great longtime partners of Market Misbehavior. They're running a Valentine's Day sale in the next week or two. I would encourage you to go to marketmisbehavior.com/Seeking Alpha for more information on their premium membership. You can also scan the QR code that you see on your screen. Seeking Alpha is something I've used regularly. I really like their quant model, which is an institutional quality quantitative model, what we call an alpha model. This is where you look for companies representing or demonstrating the characteristics of winning stocks going back over time. So it balances momentum and earnings growth and quality and stability and all the other factors you might think are interesting, combines them into different individual factors, but then into a composite rating, so you can start to look for the strongest companies based on their quant methodology. I think it's really well designed. I think it's a great way of looking at a broad universe and looking for some potential opportunities. You can check it out at marketmisbehavior.com/Seeking Alpha, or just scan the QR code that you see on your screen. Thanks again to the folks at Seeking Alpha for being great partners to Market Misbehavior, as always. All right, next question. Do you know of any data that tests the financial validity of charting, specifically chart patterns? Yeah, I love this question. I get the back testing question randomly, pretty consistently, actually, but I don't think I've shared a great answer to this in a while. So this is getting to the question of back testing, right? And so some people will believe and will swear by the fact that you have to back test everything you use. And I get it, right? If you come from a certain school of thought, more of like a scientific engineering type of mentality, for lack of a better term, you probably believe that back testing makes sense. Why would you not test something and see how it does? And I will tell you that there are always issues with the back test, right? And I used to debate this endlessly walking around the halls of Fidelity with the guy who ran the quant team at the time. I ran the technical research team, and we would just discuss and debate quantitative modeling because what he would tell me, like, he's like, yeah, what you have to remember is anytime you make a quantitative model, you're making some assumptions, from little bit of an assumption to huge assumptions. And one of the biggest assumptions you're making is that tomorrow is going to have any relationship to yesterday, right? Or by looking at this historical data, does that help us model what's going to happen? The problem is the model's only as good as the design of it. It's only as good as the data of it. And so the problem is over relying on back testing can be a problem. So one of the quotes is, I never met a back test I didn't like, right? There's so many times when something tests really well and then you put actual live money behind it and it doesn't do well because there's some assumptions that you were making that just weren't realistic, or the market just does unusual things that you weren't able to model very well. So the way that I always kind of back test is by putting live money behind something. If there's an indicator that I'm using, I run a portfolio using that indicator along with other things, or if I want to just test it, using it just by that. And if it works, then I'll use it more. And things that don't help me make money, I stop using it. So tools and techniques that I share with you on the show are things that I found add value, and they've helped me manage portfolios and manage my own investments and help clients do that for many years. So I would say the best way of measuring the financial validity of charting is to use a disciplined process of charting to measure your performance. And your performance is not good, then your charting approach is not that helpful. I would tell you one of the biggest ways to think about, and this is where I think we get into trouble, right? When people talking about the financial validity of charting, they're often talking about for idea generation, right? So there's a guy, Thomas Bulkowski, who wrote a couple really widely followed books, and I don't remember the name of them, and I apologize, Thomas Bulkowski, for not knowing the name, but basically something like something about chart patterns, the Encyclopedia of Chart Patterns, or something like that. And he goes through and provides back tested results. Like, here's what happens. So what you have to remember is, again, when you're back testing chart patterns are very visual. So number one, you have to have some way of quantifying what makes a head and shoulders top, what makes a cup and handle pattern, what makes a flag pattern. And people often debate whether or not what the back test says is a flag pattern is actually a really good flag pattern, because chart patterns are very visual. So I would say with chart patterns in particular, it's very hard to backtest. Some will swear that they've done it. I would argue they're making assumptions, and which means the results may be much better, much worse than they might be in real life. The other thing is, remember, a lot of times backtests have one indicator on their own. And my own process, for example, I have a number of different indicators that I use together, right? It's not just about using head and shoulders patterns and that's it. It's using a head and shoulders pattern along with other things. So, it's very rare that you would just use one thing and nothing else. I think that's actually a poor use of technical analysis. Final thing I would say is, when you're back testing like chart patterns, remember, I think one of the greatest benefits of technical analysis is in risk management. It's not about generating new ideas. It's about getting yourself out of ideas that are no longer working. That's something that's not usually reflected as well in back tests of things like chart patterns, because a breakdown below support and you just sell the position, that's something that's probably harder to quantify than you think, but can often be one of the best ways to survive during a period of market instability. So that's a long-winded way of saying I would argue backtests are not as awesome as you might think or might be led to believe. Some people swear by them. I do not. I more swear at them than swear by them, I guess is how you would say it. But I would say just be careful with backtests, especially with chart patterns, because you're always making plenty of assumptions about what makes a good chart pattern, what your entry and exit points are, and your experience in real life may be very different. Best thing I've learned is use these tools and techniques to manage live money. You will find out very quickly what works and what doesn't. Use the stuff that works. Don't use the stuff that doesn't work anymore. Next question. My question is, in your opinion, whether the number of distribution days in a choppy market or in choppy markets are as relevant as they are in an uptrend? It's actually a really interesting question. So number one, I guess it depends on what we mean by distribution days, right? So there are, sort of anecdotal, comments about what makes a distribution day versus, hard and fast rules, right? So I'm looking at the chart of the SPY here, just some of the volume indicators that I use, because when I think about distribution days, I'm, usually thinking about volume, right? You're thinking about a distribution day would be like a big down day on heavier volume. Um, Investors Business Daily, like William O'Neill has, when you say distribution day in the IBD methodology, it actually has a very specific thing, and that rule is, I should know this. If I remember right, it's like the stock or the ETF is down like at least a quarter of a percent or 0.2%, I think, and the volume has to be higher than yesterday. That's what I think, and if it's not that, it's something really close to that. If I remember right, it's the price is down 0.2% or more, and the volume is higher than yesterday. That counts as a distribution day. So a lot of times, if you read, the guys that write it and women that write at IBD, they'll mention, how many distribution days we've had, and that speaks to down days on heavier volume. And you can kind of see that, right, when you see these bars in red. This is the daily volume readings. The bars in red are down closes, meaning the close was lower than yesterday. So we can see when we have those things. So, more anecdotally, I think of a distribution day as like the price is down, the volume is up, is a distribution day, right? There's Because what you're trying to recognize is when investors, right, when institutions are exiting, when they're selling out of positions, when they're unwinding positions, because that would create a downward trend in price, and that would create heavier than average volume. Heavier than average volume is another thing I've seen people use as a threshold to decide whether something's a distribution day now. Right? Is it higher than the last month's average volume? Would be another way to think about it. Your question specifically, does it matter more in like an uptrend or in a sideways trend? I mean, for me, not necessarily. I mean, I think generally looking at the number of distribution days can be really helpful. I mean, arguably with the NASDAQ or with the S&P here in the last couple of weeks, we've had a number of distribution days, right? With down closes on heavier volume and heavier than average volume, right? The heavier volume has been on the down days versus the up days. That speaks to distribution. What's interesting to me is that Chaikin money flow and accumulation distribution, which are two indicators by Mark Chaikin to track trends in volume over time, are actually still quite strong for the SPY, not nearly as negative as these big, scary red bars would imply. So I would say that those volume-based indicators, which I think of all as part of that, painting a complete picture of volume, not as bad, even though we have had a number of distribution days on the S&P and the NASDAQ. Not today, though. Friday, not a distribution day with a big up close. All right, last question, then we'll call it a weekend here on Chart This. In markets like these, do you think it's prudent to use some short ETFs, for example, SH or PSQ? These are like the single inverse S&P and NASDAQ ETFs. Is it helpful to use short ETFs to hedge individual holdings versus selling out of the position? Yeah, so I can't tell you there's a right answer to something like that, and that's part of the standard disclaimer I would share with you, right? When I'm talking about charts or anything, it never represents a recommendation. The reason why I don't recommend you make certain trades, and I think other, content creators cross this line way too often, which is saying you should sell here, you should buy this stock. Here's my model portfolio, own these. I don't do any of that because I think that crosses a line and assumes that I understand your particular investment goals. This is why financial advisors, I think, still have a very important role in the markets in 2026. It's to help you think about what your investment goals are and make sure that you're investing in line with those goals. Because there's often a mismatch there, right? We're making decisions with our portfolio that but probably aren't getting us closer to our goals in a way that we could if we made better decisions. So it's hard for me to say for everyone what you should do with a position, right? In terms of hedging. Generally speaking, using hedges can be helpful if you don't want to unwind a position, right? I own a bunch of semiconductors and they're long-term holdings, right? I want to bet on long. I think the AI thing's going to work, but I'm concerned about short-term deterioration, but for whatever reason, for tax reasons, for the tax implications, for just the managing my position sizes and my allocations. I don't want to unwind some position I have, but I do want to just minimize the downside in my portfolio temporarily. That's what hedging's for, right? And there are so many ways to do that. Using options, so using a covered call strategy, using cash secured puts, which one of my who was that? Alan Ellman had a great discussion about cash secured puts. I think that was before the holidays last year on the Market Misbehavior podcast. Really interesting discussion about a different option strategy, kind of similar idea to like a covered call strategy, which is pretty widely used. Ways of just cushioning yourself to market downside. So options are possible. Taking a position in a short ETF kind of does that the same way too. Basically benefiting from a market going lower to compensate from the fact that some other part of your portfolio is going to struggle. And then instead of unwinding your main position, you're basically just trading around it and adding some cushions in there, adding some buffers. There are actually a bunch of exchange traded products that are called like buffer ETFs that use some sort of derivatives to basically have a covered call built into the ETF itself. I don't have any specific tickers to share with you, but I know that's something that's being done certainly more and more. So the decision that you make is really an individual decision about what your goals are. But I would say generally, hedging is helpful when you're concerned about short-term deterioration, but not enough that you want to dramatically change your portfolio. You just want a way to protect yourself from that short-term noise. And then eventually maybe the hedge turns into, all right, now I really need to unwind the position. And maybe there's a threshold where you hedge for a while, and then at some point, maybe you completely change your position. That's another way to think about it as well. Individual investors tend to think way too often in binary terms. I own 100% of something, or I own 0%. Remember, you have a lot more flexibility to take partial positions, to unwind a little bit, to sell a bit. That's something I did with Bitcoin on the way down. Was all right, sell a little. All right, the breakout failed. I'm going to unwind a little bit of that. All right, we broke this level of support. I unwind a little more. So remember, you've got a lot of options in terms of how you can layer into or out of positions based on what the charts are telling you. Great questions, and I appreciate those so much. Those all came from viewers like you over the last week. Please keep them coming. If there's a question that's been on the top of your mind and you haven't had a chance to ask it yet, what better time than today? Drop a comment below our YouTube channel, and we'd love to hear from you. Hope to see you tomorrow for the Super Bully stock picking competition with three of my good friends through stock charts. Should be a lot of fun. Again, you can find more information about that at marketmisbehavior.com/Super Bowl. Otherwise, have a fantastic weekend. Go Seahawks. And I will see you on Monday for another episode. In the meantime, have a great weekend. Remember, it's always a good time to own good charts. Take care, folks.